and welcome to the Neighborhood Money Podcast, a video podcast here to talk about all things personal finance and helping you build the life you deserve. Hey, if you're new here to the neighborhood, welcome. My name's Cavan. I'm one of your co-hosts, and Drew is a guy on the other side of the screen. And we're here today to talk about saving money, which, I mean, is kind of what we talk about all the time, isn't it, Drew?
I talk about it quite a bit, and even with our interviews, we tend to have people where we say, hey, what's a little personal financing for people just getting started? And it tends to be some type of saving money or some type of sacrifices that you have to make.
Right now, Drew, it is a crazy time. Inflation's, roaring rampant. People are getting crushed at the pumps, at the grocery stores. It's really hard. And, if you look at the savings accounts, you're still only getting 0.01%. CDs, you're getting, less than 1%. It's really hard for the average person that traditionally has just saved their money to actually get ahead and not just get left behind from, the inflation that's roaring across the United States right now.
In this current environment, you're definitely having to look at your bank differently. I think everybody that's a little bit in finance or personal finance or has their own checking account even knows that you don't get great returns on your bank account or your savings account. And we've kind of just taken that as it's just in there. I'm not really expecting to get anything. And that really hasn't been traditionally what's always happened. There's been some times where you've gotten pretty good returns on your savings account. And the article that we'll be going through today, it's interesting to think that the banks today are kind of a little bit different than the banks that they used to be. So your dad or your mom or your grandparents had always said, put your money into the bank, put it into a savings account, buy a CDs. That's really not cutting it anymore to keep up with inflation and growing your wealth. So I think going through this today is going to be a fun episode.
We do have an article. It's called Sorry Savers, Banks Don't Want Your Money. But before we dive into the actual article, if you get any value out of this podcast, please consider going out to Apple Podcasts and dropping a 5-star rating and letting us know what you enjoyed the most. That helps a ton to help us grow this podcast. As well as if you're watching over on YouTube, consider subscribing. Hit the like button if you do find value in the episode, and leave us a comment with any questions or even future episode topics that you may want to hear. So, Drew, let's dive right into the article. And so it's Sorry Savers, Banks Don't Want Your Money by Robert Burgess. And it's a fascinating article because it lays out, hey, at the end of the day, inflation is crushing those ultra conservative savers. So, Drew, how did we get to this point of rampant inflation? And, like you said, the banks today aren't the banks of yesterday, where banks just aren't keeping up with inflation. And I think we really have to point to the fact that coming out of the great financial crisis of 08 and 09, the federal government dropped interest rates basically to zero, which dropped bank accounts and it dropped CDs to basically zero. So you were getting nothing on those different types of investments, or I shouldn't even call them investments. You weren't getting anything on your savings.
For our generation and the generations coming up, we just think you don't get anything on your savings account. But back in 2008, when you're saying that rates got dropped down to zero, that was really the big change in banks. And now it's just second nature for us. But going through this and trying to get out of the depression or the recession, I should say, and finally maybe kind of coming back, but you're still having interest rates low. And then you go through what we've gone through the last couple of years during this little pandemic, and we've needed to find a way to keep the economy going and not going into another recession or, God forbid, depression. And that has kind of kept the banks and the Federal Reserve on their toes to make sure that, what do we do with these rates? Do we want them to go up, go down? Do we want to expand the money supply? Do we want to stimulate the economy more? And these are all questions that they've been asking, and they've all been affecting these accounts.
Maybe before we even get to how COVID has played such a huge factor in the current state of the economy, let's talk a little bit first about how traditional bank accounts, and more so CDs and those types of investments, money market accounts, how they traditionally operate. So the federal government will set the Fed fund rate, and that's basically the interest rate that the federal government sets for lending. Then on top of that, when rates are set for savings accounts and CDs. That it's based off of the Fed's funds rate. So let's just say the Fed fund rate is 1%. Well, then your CD is going to be something a little bit more than that traditionally. But now, today, that's just not the case. And the reason behind that is exactly like you said, it's because of COVID. So, because of COVID, there was a massive amount of money that got put into the economy to really prop it up through the shutdowns, the lockdowns. And that happened through two ways: through quantitative easing, which is basically saying that the federal government is buying bonds from companies, which is just giving money into the economy. And then secondly, through the multiple rounds of stimulus checks that the everyday person received.
On top of the stimulus check that people receive, their rates actually were dropping during that period of time too, so it wasn't as much of a burden onto the household. So if people needed to refinance, they could. And this was another option for them to stimulate the economy, was people had money in their pockets, their rates are really low. You might be in the place where you can buy your first home for a lower payment, or you might be able to buy some sofas and finance it, or any type of boat or ATV, and all of those went along with extending the money supply from the federal government to printing more money to lower rates, and then more money being lent out, which just keeps expanding the money supply and the deposits going into these banks.
What that ultimately does is it provides banks with just a massive surplus on their balance sheet in excess cash. And so a little bit ago, when I talked about how interest rates on like CDs and money markets kind of ebb and flow with the Fed fund rate, well, because banks have so much cash on hand, they actually don't want your money. And I think the article, that we talked about from Robert, he kind of sums this up pretty well here. So he says, in fact, the financial repression in the form of zero rates suffered for more than a dozen years by those who are ultra conservative with their savings isn't going away soon. And second, banks don't want your money. And that's because of that excess amount of cash, because traditionally banks will offer you interest in the forms of like CDs to get your money so they can loan it out. Well, when they have a massive amount of cash on hand, they have money to loan out, so they don't need to pay you that interest.
I'm just looking at some of the numbers from the article and just showing some of the money that the banks have in there. Is in December, the checkable deposits were for roughly $4 trillion, and this was an increase from 1.16 trillion in 2019. And then to really put this into perspective, back in 2008, the checkable deposits were only 200 billion. So from 2008 of 200 billion to now the money or checkable deposits in banks to 4 trillion. That's how much more money that these banks have in their accounts, that they don't really, they say, I have so much money in here, we don't necessarily need to keep up with the Fed fund rates and give your saving account higher rates.
What does that even mean, right? For the everyday person that, specifically are listening today. Well, it kind of means that if you were the type of person that has just put money away into a savings account, maybe dipped your toes into CDs or money markets, and that was your primary way to save for the future, you're going to get really hurt because of how inflation is taking off and the fact that even the CDs that probably would only provide you 2 to 3% are going to be below 0.5%. So, Drew, what can our listener do about the fact that savings right now is just not going to cut it?
First thing you have to do is be able to listen to this podcast and be aware of the situation.
Humble
So I'm
plug,
glad people,
humble plug.
yeah. But in all reality, it's something that we do have to keep an eye on, is saying that our money in our type of bank accounts aren't necessarily making the returns that they used to or that we want. So by keeping up with inflation, we're pretty much losing money. But on the other hand, you need to have liquid cash in your bank accounts to pay for bills, to build up emergency funds. You can't have everything invested. So the fact of you might not be getting the best rates in the bank account, it's still something that you want to consider, like having a certain amount inside of your bank account. These are like the goals that you can set in your household of saying, I need this much for emergency fund, I need this much for my bills, and then how much more can I put towards other assets that might be keeping up with inflation.
Yeah, so I think step number one, like you said, is having that emergency fund in liquid cash, because if you put your emergency fund into, let's just say, the stock market, well, you might beat inflation or at least keep up with inflation. But because of that volatility, what's going to happen, Drew, is the stock market is going to dip 10, 15%, and then you're going to have that emergency, and you might not even have enough money to actually pay for it. So I think, yeah, you're right. Step number one, you got to have that emergency fund set in something that's liquid like cash. That's honestly, in my opinion, the best place for it. And then even a little bit beyond that is, you're going to have your checking account, which, you're probably well aware of. You're going to have enough money in cash in there just to pay your bills. But Drew, I think one thing that people need to just try to get their hands on is what is inflation actually doing to your expenses. I think that plays into it. Like, how much more are you paying in groceries per month? How much more in gas? And try to get an understanding. That it brings us back to the budgeting aspect, but try to get an understanding of what that actually means for you, so that you can have enough cash on hand, so that you're not depleting your cash in your checking account, but actually just kind of keeping it steady.
With this inflation increasing too, something that you're are going to start seeing, like this article is saying, is the rates are now increasing. So during the stimulus side, inflation has increased. They're trying to slow inflation down, and the way they do that is increasing lendable rates for the most part, but the banks have enough cash on hand, so they're not really worried about savings accounts going up. But there's no time like the present to get this inflation thought in your mind, because with the prices increasing, this is the time when you want to be able to have a strong budget and start getting some cash set up for your emergency type of fund. Because as prices are increasing, your dollar's going less and less. And that is something that you do have to be aware of. And going forward, if you can have that emergency fund, if something does come up, you will be set for when that happens.
So I think having your emergency fund is your foundation. But beyond that, Drew, when we think about being a conservative saver that's not going to cut it anymore, trying to achieve those long term goals, you're going to have to look elsewhere outside of savings accounts, CDs, money markets. And so, Drew, let's talk a little bit about what we like to look at, what actually we're probably investing in to not even, or not just meet inflation, but hopefully exceed it over the long term. And I think the first thing that comes to mind is, if you are someone that is a very conservative investor, probably means that you don't like a whole lot of risk. You like to keep things simple. Well, one of the best things that you can look into is what are called index funds. And actually, that's my favorite investment, and my investment of choice is an index fund. And that's because it provides the simplicity of just buying one single investment, but it also gives you the exposure to the stock market, whether that's the top 500 companies in the stock market or the total stock market, if that's what you want to invest into. And because, Drew, you're investing into 500 or 3,000 different individual companies, that's reducing your risk significantly.
The index funds, I think, are a great solution for those conservative type of savers. And the reason I say that is, if you are this type of big saver, or you only like to put money into your checking account, by having these index funds, they've made it so easy to automate this whole process. So you can still put your cash into your checking account like you would have before, but then you can set up that certain percentage or dollar amount that goes into this index fund, and you won't even have to worry about doing it. So you can say, I don't even know how to trade stocks, I don't know how to buy an index fund. It might take a little bit process up front, but after it's set up, you don't have to worry about it. You don't have to constantly be trading in and out of certain stocks. As Cavan said, you're exposed to such a big part of the market that you will have some fluctuations, but for the most part, you'll still have a lot less risk exposure and a lot more chance of this asset continuing to grow as you save and put money into something as like an index fund.
You have to keep in mind that this isn't for short-term saving. If you're thinking about saving for something, let's just say within 5 years, your best bet is probably still cash because, Drew, like you said, even an index fund is going to have some volatility. For example, I think the market, like the S&P 500, is down 10 or 12% since the beginning of the year. So you're going to see still that volatility. But when we talk about reducing risk, that's really looking over the long term. And specifically, like, I'm a huge proponent of the S&P 500 index, and if you invest in that, you're basically investing in the growth of the US economy, and that's a pretty hard thing to bet against, at least in my opinion. And so if you're looking at something that's 5 to 10 years or beyond, an index fund is going to be your best friend.
Another option, it's still kind of part of the stock market, would be the real estate investment trust or REITs. And these are still a way that you can be exposed to the stock market, exposed to some growth, but you can still have fairly liquid cash or fairly liquid funds, I should say. But then you also are having an option, or not an option, but an extension of being able to have some passive income through dividends. These REITs are e- stock exchange products that the company is actually buying physical properties like multi-family apartment buildings, and they have constant and consistent cash flow. So they feel more foundational and structural, but you're still have it fairly liquid, which is nice. And if you don't want to have those dividends going back into the stock to increase value, you can have those paid out into your accounts, and then you can have that as cash on the side too. So as far as a conservative type of saver, it's another option. It has a little bit more risk and a little bit more work put into it, but being able to have something that as liquid as a REIT, but with the mental uh the mental side of saying it's actually physical property, it's not selling a product, it's already there, it's making cash flow, there's going to be tenants there for the foreseeable future.
I absolutely love REITs because it's getting invested in real estate without having to put a team around you. You don't have to find a realtor. You don't have to find a property manager. You don't have to find the property and worry about tenants. You just have to go out to the stock exchange and buy the asset, the REIT, and then you are a partial investor into real estate. And another great thing is with inflation, it's rising at 8 to 10% right now. Real inflation is really like 10 to 15%. But with inflation comes increased home prices, increased property value. So you're going to see that come through on the REIT. Now, the specific REIT that you're going to look into, obviously, you're going to have to be well aware of like expenses and, the amount of time that you have to have your money invested into it. If it's a publicly traded REIT, then that's not an issue. But if you look at private REITs, like last week when we had Craig on, there are some nuances to those different types of situations. So I just wanted to point that out. But I mean, both REITs and index funds are great from a inflation standpoint because if you think about what makes up the REITs, it's real estate that's going to rise with inflation, and then your big top 500 companies in the S&P 500, outside of like some of the tech stocks, they're going to get a benefit from inflation because a lot of them provide goods, and those goods are going to continue to be bought regardless of what inflation is at. Drew, there's a third asset that you could also consider beyond the index funds or REITs, and that's what are called iBonds. So people are pretty familiar with bonds, which is basically you're just lending your money to the government backed bonds. And so you just buy a bond, they provide you a coupon back, and then they'll give you your money back at when it expires. But now an I bond is very similar, except for the fact that it's actually tied to inflation. So if you want to at least meet inflation, an I bond could be a really, really good choice for the conservative saver.
Hey, I even get to learn on this episode. I wasn't really aware what an I bond was. So having that as an option, something that is in inflation adjusted type of bond, could be a very nice option. I don't know what the inflation adjustment goes off of, if it goes off of the CPI or goes off of some other type of report, but For as far as bonds goes and the way inflation is right now, you'd probably get a nice little return on whatever type of money you put into it. It's with the thought process of hopefully inflation will go down, but you still have this bond. And I don't know if it's a short term or long term bond. Do you know if those I bonds tend to be like short term, like less than a year, long term, more than a year?
I know that they're set based on inflation, so they ebb and flow with inflation. But yeah, I mean, at the end of the day, no matter what the actual makeup of the I bond is, just know that when you buy an I bond, it's going to at least keep pace with inflation. So one way to look at that is you just break even on your investment. You're not making any money, but you're not losing any true real money because you're just keeping up with inflation.
And it's not as liquid, but these are all options to still be within the traditional financial system and still keeping up with inflation. And if there's any other one we wanted to add in here, and it's kind of ironic that we were even going to add it, but we've talked about in a couple episodes, and that's Bitcoin. And I think for your traditional saver, they would say, I have no idea what Bitcoin is. I don't know how to buy it. It's not tangible and it's just a fad and it's passing by. Ironically, it kind of seems like one of the most conservative things you can do. It's you put money into it. It's from what our understanding of reading it, it will have a very nice appreciation going into the future. There's more and more peer-to-peer options for purchasing, so you can actually use it as a type of a savings account where you get good nice returns and it's liquid enough to start paying for other items, and there's a limited supply on it, so you never have to worry about the Fed increasing the money supply, decreasing, rates going up, rates going down. You're just going with the appreciation of the asset.
I mean, if you're a believer in cryptocurrency and the future of monies, I am, and Drew, I know you are too. Bitcoin is basically a no-brainer. All of this obviously is not financial advice, but the fact that it is the hardest money available, meaning hard money is means that it's very hard to produce, and you actually can't produce Bitcoin anymore beyond the 21 million that's ever going to exist. You can really think of it as saving in Bitcoin. And you're going to see a lot of volatility in the short term. That's because the asset class is so new, but over the long term, it's going to level out, and you're going to see that asset appreciate, pending any type of regulatory situations that may potentially hinder the asset class. But yeah, Drew, before we started this podcast, we were talking about Bitcoin and how it is truly like the most conservative place to put your money if you kind of push aside all the volatility that comes with a new asset class. So, Drew, we are in a place where interest rates are extremely low. They're rising on the Fed side, but unfortunately, on the bank side, they're not going to keep up because of the excess cash that exists in our financial service system. And so we talked about, what are some of the four different things that people could consider if they are a conservative saver. What can they consider outside of their emergency fund? So what would you say coming out of this conversation, reading this article, what is your main takeaway from it?
My main takeaway is the savings account today are not your old timey savings account. They're not something where you can put your money into and be comfortable with having some type of growth out of your money. What money's in there now is pretty much going to be the same dollar value, but lose purchasing power over time. As far as what it always used to always hear by CDs, put your money into a savings account. Out of this article, they even were showing that typically the CDs and the treasury bonds tend to move together, and the CDs are on the bank side, treasuries on the federal side. And they're showing at the CD average rate of return right now is 0.39%. And this is compared to treasury note that's around 2.7%, and just showing the treasury from 2019, or was this saying here, notes having surged from less than 1.5 last year. So just a year ago, the treasury notes are at 0.15%. So pretty similar to the CDs. And now they surge all the way up to 2.7 while the CDs still remained constant. So it is showing that your typical savings account and bank certificates of deposits are not what they used to be, and being able to get those returns. And so that's pretty much my key takeaway is through this article, it does open your eyes that the Federal Reserve and these banks aren't working as in parallel as they always used to be traditionally, since before 2008 till now.
Yeah, and I think at the end of the day, you can't control inflation. You have to have your emergency fund in place, and you're kind of your money in your savings account and in your checking account is really going to get eaten up with inflation. However, I do think that when you look longer term, and Joe, we talk about this almost every single week, you have to really put your money into investments that are going to provide you a return that will not only or keep up with inflation, but also beat inflation. So I think my main key takeaway is don't just think that you can save for the future. You have to get invested. I personally am a huge advocate of index funds because of the simplicity of them. And basically, you just set it and forget it. Like you said, you can automate it. But just specifically now that inflation is so high, you just have to be more vigilant around where your money is going, how you're maintaining your money, and making sure that you continue to keep with your long term plan. Get invested and make sure that you don't just try to save for the future because unfortunately I just don't think it's going to be enough.
This time more than ever, when you hear the term "get your fund diversified" or your funds diversified, this is probably one of the most eye-opening areas or times of our lives that you've seen that, where before, when you hear diversify your funds, you may be thinking just within the stock market, and now it's really showing that you want to diversify your funds that are in your bank account. You want to have a certain amount in emergency fund. You want to have a certain amount in cash that is going to be able to pay for your monthly bills. You want to have a certain percentage that goes towards inflation beating assets, and then some other type of conservative type of side hustles or type of investments. So I think this is a way and a time to think to diversify your bank accounts and make sure your money is being spread out, where you're taking on less risk, keeping up with inflation, and still being able to live your daily life.
Now that we're kind of like wrapping up this main segment, I feel like we've been a little too pessimistic, which rightfully so because the inflation is super high. But I'm going to leave our listener with one last thing: is the fact that if you do invest into like an index fund, the market has dropped this year. But you know what that means, Drew? Is that means that those investments are on sale and that you can really. I know I get super pumped for it, and maybe I'm a little odd that when I see my investments drop by 10, 12, 15%, I get fired up because I know when I buy, I'm buying at 10, 12% less. But so just, I think that's just a word of, being optimistic of, hey, if you buy in now at these prices, you're getting it at a discount. And if you can put a little more aside right now, it's going to help you in the long term. Drew, have you been following up on this Elon buying Twitter? Basically, the Elon takeover of Twitter.
Pretty much taken up all of my feeds, whether it be on Twitter or Instagram or news articles that I read throughout the day, or anything that's, I read within the stock market that helps stocks go up and down. It's nothing but Elon Musk is like all I hear. And I have to say, this is a pretty crazy purchase and event, really.
Putting aside like everything that comes with the political landscape that we currently live in, it's wild to me that there's somebody out there that can just buy a social media platform that doesn't make money for, I forget what he valued it. It was like around
Like
50 billion. So
44 billion.
$44 billion. Looking on Twitter and following is kind of hot and cold around like what people think. It's like either like the best thing ever, like people are fired up, or they're like, oh my gosh, it's like the worst thing ever. One person should not own Twitter, the social media giant. What are your thoughts around it?
I just laugh at a lot of the hypocrisy, or like the sides that people decide to pick. I mean, if it's one side that does something, they like talking crap about it. If it's the other side, they like talking crap. So I find that part pretty amusing. I find it really interesting that Elon Musk purchasing this for such a premium. I think the stock was trading in like the $33 range or something, and he put it at a premium of 54.20, and that's like classic Elon Musk wanting to have 420 in it.
Right, right.
But he bought it for such a premium, and he wants to take it private. So the whole actual money making side of it, it almost seems like he'll probably find other streams and he'll still make a lot of money off of it. But as far as keeping it public, you think if you were really in it for just strictly all the type of money, maybe you would keep it public just for all the fun. So I find that side of it really interesting. And just all the proceedings going forward with this deal, with it's a cash offer. So he's going to have to be selling some Tesla stock to cover part of the margin loan that he took out. And then he has another loan, I think, backed by some equity in some of his other projects. So that's some of the stuff that I'm kind of looking forward to and interested, because he's had trouble with the SEC in the past. And I think they're going to be putting up a lot of roadblocks. They want, traditionally, I think a deal like this would get done fairly fast. I think on the longer term, they're saying maybe by the end of the year, but it could even go longer depending on what type of roadblocks that SEC wants to put in, how long investigations take. So that's the side of it I like. I know Twitter world's all caught up in the free speech or not free speech, or Elon's the best or the worst, but I think just the deal in general is really interesting to me. Being able to bring it private, wanting to make different revenue streams because he's not going to probably have as much ad revenue as there was before, and making something that probably or that wasn't very profitable to something that he potentially can touch and make much more profitable. So
I think at the end of the day, anything Elon has touched over the last like 3 decades has just skyrocketed. So, from like a pure investment standpoint, I would put my money on Elon for this one. I think that he's going to take Twitter and probably make it pretty profitable. But Drew, I think the thing I'm most excited about, outside of the drama that comes with what's going on with the Elon takeover, is the fact that Elon's a huge crypto guy. So I'm going to be very interested to see how he can kind of interplay, whether it's Dogecoin. Elon's a huge Dogecoin advocate. He also is an advocate of Bitcoin, not as vocally, but he holds it. But I'm really interested to know how he takes Twitter and cryptocurrencies, Bitcoin, and even maybe Web3, and how he kind of integrates all of that, because he's a futuristic thinker. I mean, who would have thought electronic cars would be a really big thing in today's market? It's pretty crazy what he's
if
done
it wasn't
with.
for Tesla, you wouldn't be
Exactly.
seeing that many
Exactly.
EVs
So,
out there.
I mean, you think of all the stuff that he is, PayPal, Tesla, he's got a couple other billion-dollar companies. So it's really exciting to, to watch and see what actually happens with Twitter, and to see if it can not just become profitable, but really, like Tesla, kind of change the way that people operate on a day-to-day basis.
Yeah, a lot of sentiment I see on a lot of forums I read and the Twitter stuff is obviously the Doge communities loving this, and they're thinking Elon Musk's going to have Doge as the main payment, and the ecosystem's going to run around Doge, and it could be the case. And so a lot of people are looking to potentially get rich off of this, or they think it's going to be a huge pump. But the side of the cryptocurrency I think is also pretty cool, as I've seen what people talk about. What they might do with Twitter is you see so many bots in the comments. So anytime somebody rates something, there's bots after bots after bots. And something that people proposed is you would have some type of verifiable deposit, whether it's actually a payment that you give to the platform or it's just a deposit every time you log in. I think is interesting, and you lose that deposit if you went against the community guidelines. So the way they see this is if you have these bots that constantly are in the comments, they get reported, they get deleted, but then they just keep making more and more bots. For them to put some type of deposit or payment onto the platform to verify your user, it would be costing these bots millions of dollars a day just to create an account, and then they would get blocked and they lose that money. So it's supposed to potentially, in theory, get rid of these bots, and I think that's kind of a cool way of them doing it. And if that works, how is that going to be moving over to a bunch of other type of websites where it's maybe you're not putting in your username and your password and they're not stealing all your data. Maybe it's some type of deposit from your crypto wallet and they can say, okay, we can verify it and you can get access now.
Those bots are a real big thing. I mean, if you go on any type of thread that has any sort of traction, you're going to see constant bots just be like, hey, click this link. Hey, go to this, here's my WhatsApp, call this number. And it's awful because unfortunately people actually fall for that stuff. So I totally agree with you. Coming out, whatever the solution, hopefully it is reducing the bots that are out there and really just making a safer environment for the users of Twitter. And then, like you said, yeah, rolling that over into other platforms.
Yeah, so that's stuff that I think is pretty cool with this whole deal. I think people get lost into the noise and taking and picking a side, but where this platform goes forward and how this affects environment of potential billionaires purchasing more. I know you have Jeff Bezos owning the Washington Post. Elon Musk will. It's looking like he at least accepted an offer from, or Twitter accepted his offer. And there's a couple other billionaires that own media outlets. But is this going to be the start of a new thing where people like to just buy out companies in general as like a billionaire and then have access to
I mean,
all
it's
this?
it's
And
not new though. I mean,
it's
billionaires
not new.
or
Yeah.
I suppose millionaires, if you go back far enough, they've always bought out news outlets. If you think that
Yeah.
news outlets aren't ran by billionaires, like get out of here. It's the
That's
reality of
true.
the world we live in, and it's I just think the fact that Elon is Elon, where he is very outspoken and kind of just not your traditional like suit and tie business guy, but like says what he wants. I think he gets a lot of flack for that, and so outside of the fact that billionaires own all media companies, it'll be interesting to see if that noise kind of settles down and then we just go back to, well, it's just the same thing as everything.
I was just thinking about this too. He's such a quirky guy
Yeah. The fact
that
that
he
the
might
fact that
he
when he
might
bought
be
all those shares of Twitter and then he put a poll on like, hey, should we have an edit button? And it was
yeah.
like massively like, hell yeah, like put an edit button on my tweets. Like that's fantastic.
Yeah, he's really entertaining to watch and or follow on Twitter. But he's literally so quirky of a guy that I wouldn't be surprised. It wouldn't surprise me if he somehow goes through this entire process and there's something in the deal where he can back out at a certain point, and it'll be like the most of the Twitter staff decided to leave because they didn't like him, and then they change all these other things. A lot of stuff comes to light, and then he's like, "Oh, I don't think it's gonna work." So you can have it back and just create major chaos. I wouldn't be surprised. He's just a strange guy, but boy, has he done a
Yeah,
lot of
I don't know,
things.
Drew. I think I'm gonna bet on Elon. I think if he can go through with this deal with the SEC and all that, I think that Twitter's probably got a pretty bright future.
I do too. I wonder if it will ever come public again after it goes private.
Who knows? Who knows?
Well, there we have it. Another week, another episode. This episode brought to light that your savings account wasn't what it used to be. Your certificates of deposits wasn't what they used to be. It was a little bit pessimistic at times. We tried giving some optimism at the end, but really we wanted to bring to light what this article had to bring and the realities of what's happening between the banks and the Federal Reserve and our economy as a whole. So we hope that you guys got some value out of this episode. If you did, please give us a follow, like, share, or subscribe. And we hope you enjoyed it. Thank you again for listening, and we will see you next week in the neighborhood.